So welcome. Today I'm going to be looking at what we should be expecting from the Forex market this week. The second week of January, the year 2025, Euro USD, GBP USD, Forex trading analysis. So first and foremost, we are going to see how I mark out my chart and how I denote everything, how I annotate, if I may say, everything on my chart. So let us start. So basically, since we've started a new month, I believe for last week I've already marked out the levels. Normally I mark the high and the low of every month. So on the monthly chart, you'll see I have a lot of congestion on my chart because I'm tracking smaller moves of the market. So there was a sell side that I had marked out previously right here, but since it has been run, now I can look at this target as our next draw on liquidity. Everything I'm showing you is time based. This old low, this long term low that has been formed here could be. But then again, on a monthly time frame, I see this inefficiency here, price rallying into this inefficiency and could possibly react from it. Though it's not the best time to look for a reaction on the chart at the moment, but let's just expect price to reach this low. So this is our sell side liquidity, of course, long term should be. I normally denote it. Put it in bold. I don't know why it's okay. Let's do this. Yeah, that's better. So this is our long-term target for liquidity. So if you look at dealing range from this high, this swing high to this swing low, we know we have now entered into our discount, as you can see. We have now entered our discount, and there is an inefficiency that we have drawn into on the monthly chart. Okay, so I don't make decisions using the monthly chart. I just see the higher time frame picture and then I go lower to define it. So we have marked out December's high and December's low. Well and good. Now we go to the weekly chart. On the weekly chart, we have last week's price action, which is this current candle here. So allow me mark it out from the high to the low. The last week we swept the buy side and sell side of the previous week. So this high is formed at 4584. So 4584, that is 1.04584, and yeah, still denoting the chart. I'm using the red lines to denote this part of the chart. And then the low is 2241. Is 1.02241. 1.02241. I know we are always told by our mentors and all that we should not use a lot of lines on our charts, but I prefer mine being this way. Because of my trading strategy, it requires a lot of precision. I have to basically do. That's why you'll see a lot of times you'll find that like now, if I give you an example of this, you see there are so many areas, buy side, sell side, that you're seeing me denoting, and those are all liquidity pools. And I'm going to break down how I come up with those buy side and sell side, those swing highs. Sometimes a swing high is a false swing high that holds no liquidity. That's it. It holds no liquidity completely. Sometimes there are market structure shifts that are just invalid. They are not real market structure shifts. They're just supposed to trap traders to think that they're market structure shifts. There are some liquidity sweeps that are not actually liquidity sweeps, and we call those ones inducements. So I always demarcate those areas because I want to be a little bit sure. I may not be perfect, but I just want that comfortability. I want to be comfortable. Managing risk is the most important thing when you're trading. So let me mark out, yes, this is Friday's price action. We were bullish a little bit, but I wasn't contented with this bullish movement to this side. We've left this daily inefficiency that I would want to see price rally into on Monday to offer in it and continue lower. Not long term, but short term, because I'm expecting a reversal since we are in a monthly time frame fair value gap. I've been watching that fair value gap for long, and yes, and I think it should hold. Now, marking out my daily levels, my high. You feel free, you can, whoever's watching can also label your charts according to this. I believe it will help you here and there. So the time frames that I label and mark, there is the monthly, weekly, and daily time frames, highs and lows of the previous candle, immediately previous. Like if I'm on Monday, I mark out, like today, I'm marking out Friday's high and low. And I that's when I know that draw of liquidity. Yes, we have had a market structure shift at this point here to to the lower side. Now, if I was a price action trader, I would be saying that this is a downtrend because we are experiencing lower lows and lower highs. Yes, of course, such knowledge, I won't say such knowledge does not work. It works. Like there are people making money using support and resistance. Who am I to judge them? Who am I to say that they can't trade? Who am I to say that yet they are making millions from the forex market? So it's actually a good thing. It's a good thing that we learn these basic things. Now, when we bring in more advanced concepts like fair value gaps, inefficiencies, volume imbalances, mitigation blocks, breaker blocks, all those things are time based. And I completely believe that they're time based because I've back tested, I have studied the market for quite some good time. It's been about 4 to 5 years. I've been trying strategy upon strategy, left, right, and center. And it was these discoveries which I'm not yet going to disclose until I can actually openly put them online. Though for now, I'm just going to give you basics of the strategy, the time-based strategy. Of course, I won't lie there. Basically, I got it straight from the ICT macro, and I did intensive research into it, and I discovered that we have some bigger moves there. There are some things, some candles we don't focus on. We really ignore them. The time they are formed, there is always a window to enter. Smart money trades. Now, looking at this chart, we have for those of us who did statistics and mathematics and economics as well, you realize that a chart has an X and Y axis. So basically, this is what we are trading. It's time against price, of which time is a constant. We are sure about it, but we are not sure about price. So we are just plotting, we are drawing X's and O's to put areas where we are just going to collect lines. Because if I turn this into a line chart, you can tell that this low, I could have put an X there. At what time was this low formed? I could have put another X up here at this point. I could have drawn another X at on Thursday, 5th December last year. I could have drawn that. So we look at all this and we realize that we actually just doing um, some kind of graph work, but without a lot of complications like calculations. It's very simple. When you know the time that something happens all the time, you can easily mark out the price. You can easily mark out liquidity. You can easily mark out the fair value gaps. Now, most questions that people ask, and my students always ask me, is which fair value gap will price reach? There are different conditions of which fair value gaps will reach, and which fair value gaps in liquidity voids. What is a liquidity void? A liquidity void, according to me, is an area of price where there are more than two fair value gaps in a formed at a particular period of time. So what does price do? Price will normally go to the last one in that liquidity void. If it doesn't return to it immediately, eventually some later time in future, because the algorithm which you are trading, and I know it's so many people, this is a serious debate. As I'm explaining, let me keep denoting the levels. As it's a serious debate among a lot of traders that price is not driven by an algorithm. You see, if we define algorithm, we are defining a computer language that moves, that you give instructions and it does what you want to do. So no one has. I've tried doing research on who created the forex market charts, who did this. I've failed to get anything. So I I traded support and resistance. I've traded. I've used indicators. I've used all kinds of indicators. Name them. I've used support and resistance. I've used. I tried to learn uh, order flow, and I failed to understand it. For those who understand order flow, I really, that's something, it's not for me. So when you find what you can understand, what you can do your niche, because I don't, I can't say that every trader should be like, ah man, if you trade support and resistance, you should always trade support and resistance. No, that's not the case. If you trade, because if you trade ICT concepts, please, if you understand them, stick to them. If you understand smart money concepts, stick to them. Whatever you understand, stick to it, and it's going to make you profitable. You being profitable doesn't mean that you should have $100,000 on your account. No, you being profitable means you should be in profit. You can even be $50 profit. You look at the last 6 months, and your trading account is not in negatives. You're a profitable trader. Believe in yourself. Your strategy works. If you look at your account and you've made $10 from maybe the first $10 you made, and you're in $10 profit, you're a profitable trader. Though you're not at the level of every other trader, but your strategy is working. Because the math of the forex market is, the moment you make 30%, you're good to go. The moment you make 30% of all your trades correct, you're good to go. As long as you have discipline. And with discipline, you're going to you must have a risk tolerance. You'll say that I'm risking 1% to make 3%. Or I'm taking a 1 to 3. Let's say 1 to 3. That is my personal advice for any trader who is trading in the forex market. When you're trading, enter a 1 to 3 trade. Make make it a 1 to 3, because if you go beyond that, it's very hard to catch trades that will go beyond 1 to 3. And if you do the math, you'll have three trades, of 1 to 3. You lose one, you're still safe. You lose two, you're still safe. If you keep compounding it with time, you're still going to be safe, because trading needs your patience. That is one. Two, you need to know your risk tolerance. You can't tell me that you have a $10 account and you're going to risk 1 cent. No, you're going to risk of at least $1 or $2. But then, how many chances of trading will you have? Is your strategy is your strategy good enough for you to hold that trade for long? Ask yourself that question. Can you hold your trade to take profit, or you're going to get scared in the middle of it? Because I've been through that so many times. I've been through that a lot. And us being, in Uganda, getting a lot of money is not that easy. But when you get it, you have to really manage it correctly. I'm speaking on my I'm speaking about my experience about with trading small dollar accounts. I don't flip accounts. No, I'm not an account flipper. I trade. I'll trade it slowly with patience, and I will make it. That is what I gave myself. I gave myself a simple rule. A simple rule is I'm going to trade 1 to 3. That is one of my rules. I trade 1 to 3 only. Two, um, I trade two currency pairs, which is the Euro USD and GBP USD. Three, on weekends, I use Bitcoin for backtesting. Four, I don't stress myself a lot because I have a maximum loss per day. So I'll risk, let's say 10% of my account. Let's say I'm trading a $10 account. I'll risk 10% of my account, and I will get only let's say if I lose 10% of that account, it wouldn't hurt me so much because I am learning. It's a lesson. You don't come into business with the mindset of winning all the time. You're going to make losses eventually. Even in real life, when you open a shop, you're going to still make a lot of losses. So your best friend in the market is going to be you. Give yourself time, give yourself patience, love what you're doing. Know that one day you're going to break out of that cage. You're going to get yourself free, and you're going to get that freedom you've always been wanting, the financial freedom. It's going to be very difficult, very hard. You're going to go through a lot. You're going to feel like giving up, but don't give up. Trading is real. Trading will make you money. Trading will make you rich. But only the patient are going to actually reach to where they want to be. The patient, the strong, and committed. Commitment is very important. Stay committed to your skill. Learn a trading strategy. Follow trading mentors. Get a mentor. If you don't have, I did this trading thing alone and it has taken me years to learn. But if you get a trading mentor, you're going to find yourself understanding things that you would have taken 3 months, 2 months to get in a couple. If you can get it in a day, because it doesn't matter. It doesn't matter really how long it takes. As long as you're doing it alone, you're going to find a hard time doing it. So anyway, back to trading here. So I've marked out the daily high and low and the weekly expected opening price. So I've not yet checked the news calendar. Of course, the best place to find your news is on Forex Factory, and you'll get it online. As long as you type Forex Factory on Google or any other area, you're still going to get it. So now let's talk about this strategy of mine. After marking out the daily high and daily low, let's do a quick recap on the price action of last Friday to see what the euro could possibly have in store for us. So I have this area here of liquidity that price generated. This high particularly was taken and this low was taken. So that leaves us with no liquidity to be swept at this on these sides. So we have a small liquidity pool that was formed during this area I marked out. I regard it as the daily reference point. You look at it on a 1 hour perspective, and the timing is between 9 of the previous day to 4 of the current day, East African time. As you can see, UTC +3. I use East African time because I can say maybe I'm patriotic or something, but I prefer it and it's easier for me to keep track because I'm in East Africa, I'm in Uganda. So what happens is price will rally above this high and leave an inefficiency. Now on the 1 hour chart, we have this inefficiency that was filled. Now you realize price just gapped into it without leaving a wick or anything. So there was speed that was created to fill it in, and then price rallied higher. Now on the 4 hour chart, we have a gap. This is a new day opening gap. And according to ICT concepts, let me go back to that. New day opening gaps are magnets to price, and price will always come back to them. So we should be rest assured that this level here, this area between 2 6, let me highlight this, between this area here, price should run through this week and take out the liquidity that is below, that is resting below this swing low. Not this swing low, but this swing low. Of course, this swing low is also sell side. As I can see, I marked out a sell side, which means price would come and rally below both lows and continue lower. Now, on a 15-minute time frame, where I get a higher time frame bias, especially for the 4-hour candles, because there's a saying ICT gave us, his students. Of course, I wasn't one of the mentorship students, but of course, I learned from YouTube as well. And out of his concept, I got some things left, right, and center, which I use in my trading and in my strategy, my time and price strategy. So we have he has a saying that goes, if I can remember, it goes, it's about time. Yes, sorry, it's about time. It says when you treat the 1 hour and 4 hour chart as your daily chart, a whole new world opens to you, which means you'll easily get trades. You trade the 4 hour and hourly chart like you're trading a daily chart. You see? So let me move these areas, these two horizontal lines. I use them to demarcate the zones where I'm going to look for PD arrays. So basically, my trading is about finding PD arrays at particular times, which will simply give me a direction of price and which direction to trade. Of course, it's not 100% because you have to take losses in the forex market, whether you like it or not. We have to take those losses with one heart and confidently. It has to happen. So if you look here, let me try and back test a little bit. We go back to the time frame is around, the most recent one is from around 4:15 in the 15-minute chart to 5:30 the evening. So right here, what do we have? This area right here. So we see price getting into this area. Now, since it's a Friday, we don't expect to have a lot of movement in the market. It has its own kind of price action. If it were another day, we would have seen something better. So you see price trades all the way up here, rallies above this, comes back lower, creates a short-term low, rallies high again. Of course, shifts market structure from this high right here. This is a shift market structure right there. Shifts market structure and then rallies lower again to sweep this low. Now, an uninformed trader would believe this candle here is a breaker block. This particular candle right here. But to me, this is a false breaker block. And reasons I'll put in other videos. But this is a false order block. I mean breaker block. I beg your pardon. So price generates liquidity below here. Right here. Sorry. After offering at this low, this is liquidity, which is a major liquidity pool, which price sweeps the high, sweeps the low. So this is our accumulation from this point here to here, forms our accumulation. Beautiful. I believe we all agree with that. So smart money accumulated stops right here. Why did it do that? Because of this erratic move. There must have been a news release at this point, which I call the Judas swing. and that time, that also has a time frame which we mark out, and we mark out the high and low which we expect price to sweep. So both highs and lows should be expected to be swept. And though here we have relatively equal lows, which will act as our next target right here. So I would mark this as my sell side liquidity. Beautiful. So accumulated, then we manipulated lower down to this rejection block right here, right there. So because price went below 50% of it, this is a sign that we could come back to sweep this liquidity pool. There is some unfinished business down here. That is an algorithmic signature. So price comes lower, offers below there, and then we go to 8:15 to 9:30. Have this other time frame. So because we have seen this happening, we go down to the 5-minute chart. We mark out our macro. Our macro within here is from 5:50 East African time to 8:20. So what do we see? We see price rallies sweeping liquidity down here. And we have how many inefficiencies? We have 1, 2, and 3. Now, these 3 inefficiencies leaving us, which are inversion fair value gaps. So we call it inversion fair value gaps because the higher time frame tells us that we have swept liquidity and we are still bullish. So what do? We mark out the first inefficiency, which is this. That becomes our inversion fair value gap. So our inversion fair value gap. Now, one of the criteria I have for inversion fair value gaps is when price rallies above a certain area, a certain fair value gap, and inverts it, I would want smart money to offer to create an order block, which we have right here, within or below or just around that inversion fair value gap, and that is already a trade opportunity. It's like this one. That's our order block right there. So if you backtest this, you'll find that price actually respects these areas. So price offers lower, leaves a liquidity void. This is a liquidity void. But then, because it's a serious inefficiency, the algorithm has to fill these gaps. So what happens? Of course, this is our buy side. This high here is our buy side liquidity for the 2 trades we are expected to take. And yes, we look at this as buy side. So price rallies. Your first trade would be from here. You put your stop just below that inversion fair value gap, targeting a simple 1 to 3. Don't even need to go beyond it. Right there, just 1 to 3, and that's your first trade. Second trade comes in when we find another macro, which is 50 at around 1950, which is 750 to this particular time right there. Now we see price creates another order block right here, a breakaway gap over here, and then we rally higher, and you see that price respects this inversion twice, at this point and at this point. So we create a liquidity void. Now personally, I won't lie, I would be expecting price to come back to this inefficiency before entering a trade, this 5-minute fair value gap before entering a trade. But This being a breakaway gap, which I don't incorporate in my trading strategy, I would have missed this trade. So price comes, rallies, offers here. Whoever makes an entry here thinking that this is the fair value gap to trade gets it wrong. They are stopped out. Whoever makes an entry within here is also most likely stopped out if their stop is at the consequent encroachment of this fair value gap. And this being for new traders or people who are not aware would actually believe this is a mitigation block, this particular candle right here. Why? Because we have seen price rally lower, ship liquidity, create a short-term high, come back lower, find support and the previously inversion fair value gap, and then closes above this, thinking this is a valid market structure shift, which it isn't. It's just normal movement of the market. This is an invalid market structure shift. So price comes lower and then trades there. Even if you use a Fibonacci retracement tool, which mine looks more like this, you still won't get your optimal trade entry filled unless spread fills you in for those of us who are trading with spread accounts. Otherwise, this is what will happen for you. So price offers and then rallies higher, then the week closes. So I cannot predict the weekly objective, but I am more certain about daily movement of price. I'm an intraday trader. So please subscribe for daily content. I'll be trading live on YouTube each and every day, unless I am occupied with other activities in the course of the days. And we'll be executing these trades together, taking on the market together. And I wish you a very good day. Peace.